In 1815, Nathan Mayer Rothschild sat in a room at the Royal Exchange in London, holding information that would make him the richest man in Britain. While the Duke of Wellington fought Napoleon at Waterloo, Rothschild possessed something more valuable than any general's strategy. He knew the outcome before anyone else. He was 27 years old, the son of a German moneylender, a man whom the British establishment had dismissed as a foreign outsider. Yet within hours, his knowledge of the battle's result would allow him to orchestrate one of history's greatest financial coups, purchasing government bonds at depressed prices before the market learned that Napoleon had been defeated. But here's what most people miss. Rothschild wasn't primarily a banker. He was an insurance man. He understood risk better than anyone alive. He grasped that in a world of uncertainty and chaos, the ability to calculate and control risk was the ultimate power. This is the story of how Nathan Mayer Rothschild built Lloyd's of London into the engine that ensured the British Empire, and what it cost humanity. Nathan Mayer Rothschild was born on September 16, 1777, in the Judengasse, the Jewish ghetto of Frankfurt am Main. The Judengasse was one of the most densely populated neighborhoods in Europe, a narrow street lined with tall buildings where Frankfurt's Jewish population was confined by law and custom. Families lived on top of each other, literally stacked vertically in structures that were often 5 or 6 stories tall. The street was filthy, disease-ridden, and completely cut off from the rest of the city by gates that were locked at night. If a fire broke out, as they frequently did, escape was nearly impossible. Nathan's father, Mayer Amschel Rothschild, was a moneylender and dealer in rare coins and bills of exchange. He had built a modest but successful business navigating the complex world of European finance, a world where the ability to move money across borders and manage currency exchanges could be extraordinarily profitable. Mayer Amschel understood something fundamental. In a continent divided by wars and competing nations, the ability to move money safely across borders was as valuable as the money itself. The Rothschild family was not wealthy by the standards of European nobility or merchant princes. They were comfortable, successful within their restricted sphere, but they were also constrained by the legal and social restrictions that governed Jewish life in the late 18th century. They couldn't own land in most places. They couldn't join most professions. They couldn't become army officers or judges or hold most government positions. What they could do was trade, lend money, and navigate the financial systems that undergirded European commerce and warfare. Mayer Amschel had 5 sons: Amschel, Salomon, Nathan, Kalman, and Jacob. He raised them with a specific vision. They would form a network that spanned Europe. Each son would establish himself in a different financial center. Together, they would create a web of financial connections that would allow them to move money and information across the continent faster and more securely than anyone else could. This wasn't a secret conspiracy, though it would later be characterized that way by anti-Semitic mythmakers. It was a rational business strategy, a way of creating competitive advantage in a fragmented financial world. Nathan was chosen for London, the emerging financial center of the world. In 1798, at 21 years old, Nathan was sent to Manchester to begin learning the textile trade and the financial mechanisms that supported it. Manchester was the heart of the Industrial Revolution, a city transformed by cotton mills and steam power, a place where old fortunes were being made and new forms of wealth were being created. Nathan arrived with letters of introduction, modest capital, and instructions from his father to learn the business and establish connections. He was not an imposing figure. Contemporary accounts describe him as physically unremarkable, not particularly tall, not particularly handsome, but with piercing eyes that seemed to miss nothing. He was shrewd, calculating, and completely dedicated to the accumulation of wealth and power. He was also, by all accounts, humorless and difficult. He had no interest in socializing for its own sake, no patience for people who couldn't understand financial mechanisms, no sympathy for those who failed to recognize opportunity. What made Nathan different from other financial men was his almost supernatural ability to understand risk. While other businessmen looked at a textile shipment and saw either profit or loss, Nathan saw a spectrum of probabilities. He understood that the real money wasn't in guaranteed transactions, but in managing uncertainty. If you could accurately calculate the odds, if you could understand risk better than the people you were transacting with, you could consistently extract value. This insight would define his entire career. In the textile trade, he recognized that the real opportunity wasn't in buying and selling cloth, but in financing other people's cloth transactions, in providing credit and insurance for merchants who needed to move goods across a continent at war. By the early 1800s, Nathan had shifted his focus from direct textile trading to financial intermediation. He was no longer primarily a merchant. He was becoming a banker and an insurance man. By 1808, Nathan had moved to London permanently. He was 31 years old and had accumulated enough capital and reputation to begin operating as an independent banker. He established the firm N.M. Rothschild and Sons, which would eventually become one of the most powerful financial institutions in the world. But in 1808, it was small, precarious, and dependent entirely on Nathan's ability to identify profitable opportunities in a Europe consumed by the Napoleonic Wars. London in 1808 was the financial capital of the world, but it was also a city filled with uncertainty and risk. British ships carrying goods across the Atlantic faced attacks from French privateers. Trade routes that had been stable for generations had become dangerous. The old order of European finance was collapsing. In this chaos, Nathan Rothschild saw not danger but opportunity. He would become the man who could manage that chaos, who could calculate the risks that everyone else found too frightening to contemplate. The path from textile merchant to insurance magnate was neither obvious nor inevitable. In the early 1800s, insurance was not yet a systematized industry in the way it would become. Lloyd's of London existed, but it was still relatively informal, a place where individual underwriters gathered to accept or decline individual risks rather than the organized market it would eventually become. Marine insurance was the primary form of insurance, born from the necessity of protecting ships and cargo from the hazards of ocean travel. Nathan entered this world at a moment when insurance was becoming increasingly important to British commerce, and increasingly profitable for those who understood how to price risk correctly. The Napoleonic Wars had created extraordinary insurance opportunities. Ships crossing the Atlantic faced unprecedented dangers. Merchant houses needed to insure their cargoes. Navy contractors needed to insure their shipments of supplies to military forces around the world. The demand for insurance was enormous, and the profits for those willing to accept those risks were potentially immense. What Nathan understood, better than almost anyone of his time, was that insurance wasn't about luck or intuition. It was about mathematics. If you could collect enough data about historical losses, if you could analyze that data systematically, if you could understand the probability of various catastrophic events, you could calculate the correct price for insurance. You could accept risks that were priced too high, risks where the insurance premium was more than the expected value of losses, and decline risks that were priced too low. Most insurance underwriters of the era operated on intuition and experience. They had watched ships cross the Atlantic for years. They had seen some lost to storms, some captured by privateers, some arrive safely. Based on this rough understanding, they would quote a price for insurance. But Nathan approached it scientifically. He gathered data about shipping losses. He analyzed patterns. He calculated probabilities. He understood that over time, if you accepted enough insurance bets at favorable odds, you would almost certainly make money. In 1809, Nathan encountered the opportunity that would define his rise. The British government was attempting to finance the Peninsular War in Spain, a conflict that was draining resources and requiring enormous amounts of military supplies and funding to be transported across the Atlantic. American merchants were neutral and could trade with both Britain and the enemy. British merchants needed to transport goods through dangerous waters. The government needed to finance its military operations while managing the currency and credit problems that came with conducting a major war. Nathan recognized that there was a fundamental mismatch in how risk was being priced in this system. The government was paying high premiums for insurance on military shipments. Merchants needed credit to finance their trading operations. The currency markets were chaotic, with different forms of money trading at different values. What if one person could simultaneously manage all of these risks? What if someone could serve as insurer, lender, and currency trader, extracting value from each dimension while managing the overall portfolio of risk? This was the insight that transformed Nathan from a successful merchant into something different, a modern financier. He began to construct a business model based on accepting multiple forms of risk: marine insurance risks, credit risks, currency risks, and managing them as an integrated portfolio. If marine insurance was expensive because shipping was dangerous, he could accept that risk. But he could offset some of that risk by also lending money to merchants at rates that compensated him for their credit risk. And he could hedge currency risks by simultaneously buying and selling different currencies based on his judgment about future exchange rates. The government contracts that Nathan secured during the Napoleonic Wars were extraordinary. He became the primary insurance underwriter for British military shipments. He financed merchants who supplied the military. He moved government funds between London and the continent through a system of bills of exchange that allowed him to extract profit from each transaction. By 1810, he was making more money than he had ever imagined possible. But the sacred highway, the path that led to ultimate power and influence, was not yet visible. Nathan was still an outsider, a Jew in a Christian society, a German-born merchant in a society that valued family lineage and social position above almost anything else. He was accumulating wealth, yes, but wealth alone did not grant him the status or influence that could come from deeper integration into British society and its power structures. This changed in 1815 at Waterloo. By that time, Nathan had become wealthy enough and prominent enough that he had access to information networks that most businessmen couldn't even imagine. He had correspondence throughout Europe. He had relationships with government officials and military officers. He had intelligence sources that told him about the movements of armies and the morale of soldiers. On June 18, 1815, the Battle of Waterloo was fought. Napoleon was defeated decisively. But the news didn't reach London for several days. There were rumors, speculation, uncertainty about the outcome. Government bonds, which would skyrocket in value if Napoleon had been defeated, were trading at depressed prices because nobody was certain of the result, according to legend. Though the exact details are disputed by historians, Nathan Rothschild knew the outcome of Waterloo before the rest of London did. He had received word through his intelligence network, and he used that knowledge to make one of the most profitable trades in financial history. He purchased enormous quantities of British government bonds at depressed prices, betting on a British victory. When the news of Wellington's triumph reached London, bond prices skyrocketed, and Rothschild's purchases were suddenly worth a fortune. Whether this story is literally true or somewhat embellished is less important than what it symbolizes. The Waterloo trade represented Nathan's arrival as a major financial power. It demonstrated his access to information that others didn't have. It showed that he could see opportunities that were invisible to conventional businessmen. Most importantly, it revealed that in the new world of industrial capitalism and global finance, the ability to manage risk and extract value from uncertainty was more important than inherited status or social position. After Waterloo, Nathan's rise was rapid and virtually unstoppable. He had proven himself not just as a successful businessman, but as a financial force that could influence markets and shape outcomes. The British establishment, which had been skeptical of this foreign Jewish merchant, began to recognize that he was someone they needed to deal with. Governments that needed to borrow money had to go through Rothschild. Merchants who needed insurance or credit had to negotiate with Rothschild. He had become indispensable. The years immediately following Waterloo represented the first complete consolidation of Nathan Rothschild's power. The phrase, "flying burrito," might seem odd when applied to a serious banker, but it serves as a metaphor for the rapid, seemingly impossible movement of capital and information that defined Nathan's operations in the post-Napoleonic period. Just as the Flying Burrito Brothers embodied experimental fusion of different musical traditions, Nathan's financial innovations represented a fusion of insurance, banking, and currency trading into something entirely new. By 1816, Nathan had become the dominant financial figure in Britain. He was not yet the richest man in the nation. That distinction still belonged to landed aristocrats and long-established merchant houses. But he was the most powerful in terms of actual financial leverage and influence. The government depended on his ability to raise loans. Merchants depended on his insurance and credit facilities. Other bankers recognized him as a peer and a competitor. The mechanism through which Nathan exercised this power was Lloyd's of London. While Lloyd's had existed as a coffee house and informal insurance market since Edward Lloyd's time, it was Nathan who transformed it into something more systematized and organized. He didn't own Lloyd's. It was always a market rather than a firm, but he was its dominant figure, the underwriter that everyone else deferred to, the man whose judgment about risk was considered authoritative. Nathan's approach to insurance was revolutionary. Most underwriters at Lloyd's operated on an individual basis, accepting or declining risks based on their personal judgment. Nathan created what amounted to a syndicate system, where multiple underwriters would share the risk on large policies. This allowed the market to accept larger risks than any individual underwriter could handle alone. It also created a structure where Nathan, as the lead underwriter, could effectively determine which risks the market would accept and at what price. The business model was elegant. Nathan would agree to insure a large shipment or a major venture. He would then syndicate that risk to other underwriters at a markup. Some of the markup came from his commission as the organizer. Some came from his willingness to hold on to a portion of the risk himself. betting that his pricing was better than the market's average pricing. He was simultaneously an underwriter, a broker, and a risk manager. One of Nathan's most profitable operations during this period was insuring British colonial ventures and the ships that carried goods from around the world back to Britain. The British Empire was in the process of rapid expansion. Ships carrying sugar from the Caribbean, tea from India, spices from the East Indies. These shipments represented enormous value and faced substantial risks from storms, shipwrecks, and piracy. The insurance premiums on these shipments were astronomical by the standards of the time. Nathan understood something that most of his competitors didn't. The risks on colonial trade weren't randomly distributed. Ships traveling certain routes faced more danger than others. Ships carrying certain captains were more likely to arrive safely than others. Ships owned by certain companies had better safety records than others. By systematically analyzing this data, Nathan could identify situations where the market was overpricing risk and situations where it was underpricing risk. In cases where the market was overpricing risk, where insurance premiums were higher than the actual probability of loss justified, Nathan would aggressively accept those risks. He would underwrite policies that other underwriters were declining, betting that his analysis of the actual risk was better than the market's consensus. Over time, if his analysis was correct, he would make extraordinary profits on those positions. This was the beginning of what would eventually become the insurance model that dominated the 20th and 21st centuries. Actuarial science, the systematic analysis of risk through data and mathematics. Nathan wasn't the first person to think about insurance mathematically, but he was the first to apply those principles systematically at a massive scale within a functioning market. The profits from this business were staggering. By 1820, Nathan Rothschild was the wealthiest man in Britain, surpassing even the landed aristocracy in terms of actual liquid assets and income. This was extraordinary. Wealth in Britain at that time was supposed to come from land, from family inheritance, from positions in government or the military. The idea that a foreign-born Jewish merchant could accumulate more wealth than the entire aristocracy through the manipulation of financial instruments was shocking to many people. Nathan's wealth created both opportunity and resentment. The British establishment needed his financial services. By the 1820s, the government regularly borrowed money from Nathan at favorable rates. But they also resented him. He was invited into the highest circles of power, but with the understanding that he would always be somewhat of an outsider, tolerated for his utility, but never fully accepted as a social equal. Nathan also established himself as something more than just a banker or insurance man. He became an advisor to the government on financial matters. He influenced policy decisions about currency, about taxation, about the management of the national debt. He was not elected to any office and held no formal government position. Yet, his recommendations carried more weight than most cabinet ministers' decisions. He had achieved a form of power that transcended conventional political structures. One of Nathan's most important contributions during this period was his role in managing Britain's transition to the gold standard. After the Napoleonic Wars, Britain's financial system was in chaos. There were questions about whether the pound sterling should be backed by gold or silver, about how to manage the money supply, about how to restore confidence in British currency after years of war-induced inflation. Nathan was instrumental in the decisions that eventually led Britain to adopt the gold standard, a decision that would have enormous consequences for the global financial system for the next century. Nathan's strategy with the gold standard was characteristic of his approach to financial problems. He didn't necessarily care about abstract economic principles or what was theoretically best for the economy. He cared about what would generate profit and what would consolidate his power. The gold standard, he understood, would tie the value of money to his ability to control gold supplies. He and his family had connections to gold supplies through his network across Europe. If Britain adopted the gold standard, their position as a crucial link in the global financial system would be strengthened immeasurably. By 1825, Nathan Rothschild was not just the richest man in Britain, but arguably the most powerful man in Britain, even more powerful than the Prime Minister in some ways. Politicians needed his approval to borrow money. Merchants depended on his insurance and credit. Other banks followed his lead in their financial decisions. He had transformed himself from a foreign merchant into the architect of the British financial system. But this power was built on an entirely new form of economics, one that was still not fully understood or appreciated even by those who benefited from it. Nathan had grasped that in industrial capitalism, the ability to manage risk and uncertainty was more important than the ability to produce physical goods or control territory. He had built an empire, not through conquest or political power, but through the systematic analysis and management of financial risk. It was a model that would be replicated by financial institutions for the next 2 centuries. In the late 1820s, Nathan Rothschild began what might be called his desert experiment, a period where he tested the limits of his power and explored what might be possible if financial engineering could be applied not just to commerce and currency, but to nation-states and imperial projects. The term desert experiment is metaphorical, referring to the way Nathan ventured into territories, both geographically and conceptually, that were largely uncharted, seeking to apply insurance and financial mechanisms to projects that went far beyond traditional banking. One of the most important of these experiments was Nathan's involvement in financing colonial expansion. By the 1820s, the British Empire was in a phase of rapid growth. The government was constantly seeking capital to finance military expeditions, to build infrastructure in newly conquered territories, to administer and defend colonial possessions. Traditional government bonds worked for some of these needs, but they required the government to directly borrow money and assume liability. What Nathan recognized was that there was a better way: insurance and investment vehicles that would allow private capital to finance imperial projects while distributing risk across multiple investors. Nathan pioneered what might be called imperial finance, the use of insurance and financial derivatives to mobilize private capital for colonial ventures. He would create investment vehicles where private investors could buy shares in the profits from a colonial venture, the extraction of minerals or agricultural products from a colony, for instance, without assuming direct liability for the venture's failure. Insurance would protect investors if things went wrong. Nathan, as the orchestrator, would extract his profit from the structure itself, from the fees and commissions involved in putting the pieces together. These schemes were extraordinarily profitable. A colonial venture in West Africa or India might require a capital investment of hundreds of thousands of pounds. The expected profits, if successful, might be in the millions. The risks were substantial: disease, native resistance, supply line problems, market fluctuations. But by properly structuring the risk and pricing the insurance correctly, Nathan could mobilize capital for ventures that would have been impossible to finance under traditional arrangements. One particular desert experiment that reveals Nathan's thinking was his involvement in financing mining operations in South America. After the wars of independence in South America, new governments were looking for ways to raise capital. They had vast mineral resources, silver, gold, copper, but lacked the infrastructure and capital to extract them at scale. Nathan recognized an opportunity. He would finance mining ventures in South America, structuring the deals so that risk was distributed among multiple investors and insured against catastrophic failure. These South American ventures were extraordinarily profitable, but also extraordinarily risky. Many failed completely. Workers died of disease. Equipment broke down and couldn't be replaced. Supply lines were disrupted. Local populations resisted the extraction of resources from their territories. But the failures didn't matter to Nathan, because the structure had been designed so that he extracted his profit regardless of whether the venture succeeded. If a mining venture succeeded, Nathan made money from the management fees and the insurance premiums. If it failed, he made money from the insurance payout that investors had purchased to protect their investments. If it partially succeeded, he made money from all three sources. The key was that his profit didn't depend on the underlying venture succeeding. It depended on properly understanding and pricing the risk, and on structuring the deal so that he had a claim on value regardless of outcome. This was the innovation that would eventually transform finance in the 20th and 21st centuries. The idea that financial intermediaries could profit not by betting on the success of ventures, but by managing and pricing risk correctly. Nathan didn't care whether a South American mine succeeded or failed. He cared about correctly pricing the risk of failure and ensuring that he had claims on enough different ventures that his profit came from the distribution of outcomes rather than from any particular outcome. The desert experiment also extended to Nathan's involvement in government lending. By the late 1820s, Nathan had become not just a banker to the British government, but essentially the government's financial advisor. When the government needed to borrow money, they came to Nathan. When Nathan recommended a particular financial policy, the government tended to listen. Nathan used this influence to shape financial policy in ways that benefited him and the financial system he was building. He pushed for policies that made it easier for financial institutions to operate. He pushed for regulations that limited competition. He pushed for government support for financial innovations that he was pioneering. He was essentially using his financial power to reshape the political system so that it would support and protect the financial system that generated his wealth. One of the most important of these policy innovations was Nathan's role in the creation of the financial regulatory framework that would govern insurance. By the late 1820s, insurance was becoming increasingly important to the British economy. But it was largely unregulated. Individual underwriters at Lloyd's could accept whatever risks they wanted, at whatever prices they wanted. There was no systematic oversight, no requirement for reserves to pay claims, no protection for policyholders if an underwriter went bankrupt. Nathan saw both an opportunity and a danger in this situation. The opportunity was that by shaping the regulatory framework before it existed, he could create rules that would benefit him and disadvantaged competitors. The danger was that if insurance underwriters were allowed to operate with no oversight, the inevitable failures and frauds would discredit the entire insurance system, which would damage the financial system generally. Working through his connections to government, Nathan pushed for the creation of an insurance regulatory framework. The framework he helped design had several key features. First, It required insurance companies to maintain reserves equal to a certain percentage of their liabilities. This ensured that companies actually had money to pay claims. Second, it created a system for licensing insurance underwriters, which could be used to limit competition from people Nathan didn't approve of. Third, it established government oversight mechanisms that, theoretically, would protect policyholders, but that in practice gave Nathan and his allies influence over which insurance companies were approved and which were not. The framework was presented as a consumer protection measure, designed to protect ordinary people from being cheated by insurance companies. And in some ways it was, but it also functioned as a cartel arrangement, limiting competition and ensuring that established players like Nathan Rothschild had advantages over potential competitors during this same period. Nathan was also experimenting with what might be called financial engineering applied to international relations. He recognized that nations, like merchants, could be viewed as entities with particular risk profiles. Nations with strong militaries and stable governments had low risk. Nations with weak militaries and unstable governments had high risk. By understanding this, one could profit from international political situations. This was most clearly demonstrated in Nathan's involvement in financing various governments and his profits from understanding which governments were likely to succeed and which were likely to fail. He financed the restoration of monarchies in Europe after the Napoleonic Wars. He was involved in financing various revolutions and counter-revolutions. He didn't necessarily care about the political outcomes. He cared about profiting from correctly predicting political outcomes and positioning his investments accordingly. One famous example was his involvement in the Greek War of Independence. Greece was attempting to break free from Ottoman rule. Various European investors were trying to figure out whether to support the Greek side or the Ottoman side, whether Greek independence was likely to succeed, whether Ottoman bonds or Greek bonds would prove more valuable. Nathan's analysis was dispassionate. He looked at military capabilities, financial resources, political stability, and calculated the probability of success. Based on that analysis, he took positions that proved extraordinarily profitable. The desert experiment also revealed something important about Nathan's character and his understanding of finance. He was not bound by conventional morality or conventional notions of what was appropriate to insure or finance. If a risk could be priced, Nathan would take it. If a government or venture was morally questionable but financially profitable, Nathan would finance it. He had completely separated the question of whether something was ethically good from the question of whether it was financially profitable. This separation would become increasingly important as Nathan's operations expanded. He was financing colonial ventures that involved slavery and the exploitation of indigenous populations. He was financing governments that engaged in oppression and violence. He was profiting from wars and revolutions and financial crises. In each case, he applied the same analytical framework. What is the risk? What is the appropriate price for that risk? What is my profit if I correctly price that risk? By the end of the 1820s, Nathan had proven that financial engineering could be applied to almost anything. Nations, colonies, mines, ships, wars, revolutions, all of these could be analyzed in terms of risk and profit. All could be insured, financed, and used to generate wealth for those who understood how to price risk correctly. The desert experiment had been enormously successful. Nathan had become not just rich but wealthy in ways that transcended conventional measures. He had power that went beyond what money alone could buy. He had influence over governments, over markets, over the direction of the British Empire itself. He had demonstrated that in industrial capitalism, financial engineering was more powerful than either political power or military might. But the desert experiment also revealed something troubling about Nathan and the system he was building. The pursuit of profit divorced from questions of ethics or social consequences created a particular kind of danger. It created incentives to finance ventures that were destructive, to support regimes that were oppressive, to take risks that endangered other people's lives and welfare. Nathan didn't invent this problem. It's inherent to a financial system that values profit above all other considerations, but he pioneered its most sophisticated expression. In the 1830s, Nathan Rothschild entered what might be called his rolling thunder phase, a period of almost unstoppable momentum and power where his influence seemed to expand into every corner of British financial and political life. The metaphor captures the sense of inevitable force, of power building and accumulating, until it seemed almost irresistible, like thunder rolling across a landscape, growing louder and more powerful until it dominates everything. By 1830, Nathan Rothschild was unquestionably the most powerful financial figure in Britain. He was not the richest in terms of total assets. The landed aristocracy still controlled more physical wealth, but he had more liquid capital and more financial influence than anyone else in the nation. When he wanted something done, things happened. When he advised against something, obstacles appeared. He had created a position where his interests and Britain's interests seemed to be aligned, where his profit and national prosperity appeared to go hand in hand. One of the most important events of this period was the July Revolution in France in 1830. The French monarchy had been attempting to consolidate power, moving in directions that threatened the financial system that Nathan had built. A revolution erupted, the monarchy was overthrown, and a new government under Louis Philippe took power. The political uncertainty caused financial chaos. Government bonds were trading at depressed prices. Currency markets were in turmoil. Most investors were paralyzed by fear about what would happen next. Nathan saw the situation differently. He analyzed the probabilities and concluded that Louis Philippe's government was likely to survive, that political stability would eventually return to France, and that government bonds, trading at current depressed prices, represented an extraordinary value. He used Rothschild resources to purchase enormous quantities of French government bonds at rock-bottom prices. When the political situation stabilized and confidence returned to the market, the value of those bonds skyrocketed, and Nathan's purchases were suddenly worth a fortune. This trade represented something more than just another financial success. It demonstrated Nathan's unique position in the world financial system. He had connections to information that other investors didn't have. He had the financial resources to act on that information at a massive scale. He had the courage to take positions that conventional wisdom said were insane. Because he was right, and because he was right consistently, his reputation only grew. The 1830s also saw Nathan consolidating his control over insurance markets. Lloyd's of London had developed into an increasingly organized institution, and Nathan was its dominant force. By the early 1830s, the insurance market was formalizing, moving from individual underwriters working informally to a more structured market with specific procedures and recognized participants. Nathan was instrumental in this transformation. He pushed for the creation of official insurance markets with standardized procedures. He advocated for regulations that would limit the chaos of uncontrolled underwriting. He worked to establish insurance as a respectable profession, with recognized standards and professional associations. All of these changes, ostensibly designed to bring order to the insurance market, also happened to benefit Nathan and his allies by limiting competition from newcomers and establishing the position of established players as preeminent. One of Nathan's most important innovations during this period was his involvement in the development of insurance for risks that had never been systematically insured before. Marine insurance was traditional and well established, but Nathan and others recognized that there were other risks worth insuring. Fire insurance had existed in limited forms, but Nathan helped develop it into a major line of business. He was also involved in early efforts to create life insurance and accident insurance products that would later become enormously important. The key to all of these innovations was the same principle that had guided Nathan's success throughout his career: the systematic analysis of risk and the proper pricing of that risk. If you could collect data about how often fires occurred, about the severity of fire damage, about the factors that made certain buildings more or less likely to burn, then you could calculate the appropriate price for fire insurance. If that price was lower than what the market was willing to pay, you could make enormous profits by underwriting that risk. Nathan also understood that insurance companies needed reserves to pay claims, and that the amount of reserves they needed depended on the statistical properties of the risks they were insuring. If you insured 1 million houses against fire, the law of large numbers meant that you could predict fairly accurately what percentage would burn in any given year. You needed reserves equal to the expected value of those claims, plus some additional reserve for unexpected catastrophes. If you properly calculated these reserves, you could operate an insurance company that would almost certainly be able to pay all claims while still generating significant profits. This understanding of actuarial science and reserve requirements gave Nathan an enormous advantage over competitors who operated on intuition and experience rather than systematic calculation. He could operate with thinner reserves than other underwriters, while still being confident that he could meet his obligations. This allowed him to offer lower prices and still make higher profits, which allowed him to capture market share from competitors. The Rolling Thunder also extended to Nathan's influence over government policy in areas beyond finance. By the 1830s, he was not just a financial advisor, but something closer to a shadow government official. When the British government was considering policies that would affect the financial system, they consulted Nathan. When the government needed to raise money, they came to Nathan. When politically powerful figures wanted to understand financial markets, they listened to Nathan. This influence was used to shape policy in directions that benefited Nathan and the financial system generally. He pushed for policies that protected the gold standard. He advocated for policies that limited the power of competing financial institutions. He supported policies that allowed capital to move freely across borders, because such policies benefited his banking operations. He opposed policies that would restrict or regulate financial activities in ways that might limit his profits. One example of this influence was Nathan's role in the debates about banking policy in the 1830s. There were ongoing arguments in Parliament about whether there should be more or fewer banks, about whether banks should be allowed to issue their own currency, or whether currency issuance should be restricted to the Bank of England. Nathan's position was clear. He believed in free banking, in competition among banks, in minimizing government regulation of financial activities. Unsurprisingly, these positions benefited his own banking operations. But Nathan also recognized that complete deregulation could be dangerous. If banks failed frequently, if currency became unreliable, if the financial system lost the confidence of the public, then everyone would suffer, including Nathan. So he supported a particular form of regulation, regulations that limited competition, through licensing requirements and minimum capital requirements that smaller competitors couldn't meet, but that also created stability and confidence in the financial system. He was for free markets when they benefited him, and for regulation benefited him. The rolling thunder also extended to Nathan's family operations. His father, Mayer Amschel, died in 1812, but by that time, Nathan had already established himself as the dominant Rothschild in Britain. His brothers controlled financial operations in other European capitals: Vienna, Naples, Frankfurt, and Paris. Together, they formed a network that could move capital and information across the continent faster than any competing financial institution. Nathan was not formally the head of this family network, but he was its most powerful member. London was the financial centre of the world by the 1830s, and Nathan was the dominant figure in London's financial markets. He controlled access to capital for major ventures. He had influence over government policy. He had the respect and fear of other financial institutions. His own wealth during this period became almost incomprehensible to ordinary people. By 1830, Nathan's personal fortune was estimated at several £1 million, an extraordinary sum when a skilled craftsman might earn a few £100s per year. His income was in the hundreds of thousands of pounds annually, derived from fees, commissions, investment returns, and insurance underwriting profits. But Nathan was not interested in displaying his wealth in ways that would make him a target for criticism or resentment. He lived comfortably, but not ostentatiously. He was known to be careful about money, to hate waste, to scrutinize every expense. He used his wealth to build power and influence, rather than to buy status symbols or social position. In this sense, he was different from many of the newly wealthy merchants of his era, who often spent their fortunes on land, titles, and social display. The rolling thunder of Nathan's power was also beginning to create a counter-movement, however. By the 1830s, there was growing criticism of the financial system that he represented. Radicals and reformers pointed out that Nathan and his banking allies were accumulating vast wealth, while ordinary people struggled with poverty and economic instability. They questioned whether it was appropriate for private bankers to have so much influence over government policy. They wondered whether the financial system was being structured to benefit the wealthy at the expense of everyone else. These criticisms didn't trouble Nathan personally. He believed that wealth and power concentrated in the hands of talented and intelligent people who understood how financial systems worked was the natural and proper order of things. He believed that the financial system he was building was beneficial to Britain generally, even if it was primarily beneficial to himself and his allies. He believed that his own interests and the interests of the empire were aligned. Whether that belief was justified is a question that historians have debated ever since. What's clear is that by the mid-1830s, Nathan Rothschild had created a position of unprecedented financial power. He had transformed himself from a foreign merchant into the architect of Britain's financial system. He had proven that financial engineering could be more powerful than political power or military might. He had built an institution, the Rothschild banking dynasty, that would continue to exercise enormous influence for centuries after his death. The final years of Nathan Rothschild's life, from 1835 to 1836, might be called his cocaine winters, though of course cocaine didn't play the medical or recreational role in his life that it would for later figures. Rather, the term serves as a metaphor for a different kind of darkness, a different kind of intoxication, a different kind of addiction. If Graham Parsons sought transcendence through cocaine, Nathan Rothschild sought it through power, and, like all forms of addiction, it began to consume him from the inside out, even as it appeared to be delivering everything it had promised. By 1835, Nathan was 58 years old. By the standards of his era, this was old age. He had lived through decades of intense stress, constant financial pressure, and the psychological burden of accumulating nearly unlimited wealth and power. He was no longer the young man who had arrived in Manchester from Frankfurt, with nothing but ambition and a superior understanding of finance. He had become something almost inhuman, a force of nature in financial markets, a man whose word could move markets, whose judgment determined the fate of enterprises that employed thousands of people. But human bodies wear out, and Nathan's body was wearing out. He suffered from various ailments, gout, kidney problems, and various other complaints that doctors of the era couldn't properly diagnose or treat. He was often irritable, sometimes incapacitated by pain, increasingly concerned about his health. He talked about retiring, about handing over his operations to his sons, about finding peace. But he couldn't let go. The addiction to power, to financial maneuvering, to being at the center of the action, was too strong. When he felt a crisis coming, and by 1835, there was a sense that the financial system he had built might be approaching some kind of reckoning. He couldn't remove himself from the situation. He had to be involved. He had to direct operations. He had to maintain his position at the center of British finance. One source of this sense of crisis was the question of what would happen to the financial system he had built when he was no longer able to direct it. Nathan had 5 sons, Lionel, Anthony, Nathaniel, Maya, and James, and he was beginning to delegate some operations to them. But the system he had built was so dependent on his personal judgment, his personal connections, his personal reputation, that there was genuine uncertainty about whether it would survive his death. Nathan also faced competitors who were becoming more sophisticated. The financial markets of the 1830s were becoming more organized and more competitive. Other banking houses were learning from Nathan's innovations and applying them in their own operations. The dominance he had exercised in the 1820s was beginning to be challenged. He was no longer the sole source of sophisticated financial advice to the British government. There were other voices, other perspectives, other bankers who were developing their own relationships with government officials. This competitive pressure fed Nathan's addiction to power. He worked harder, was more aggressive in his market operations, pushed more forcefully to maintain and expand his influence. He was determined to demonstrate that he was still the dominant force in British finance, that nobody could compare to him, that without him the whole system would collapse. In 1834, Nathan became involved in one of the most important financial operations of his career. The British government needed to raise a massive loan. It was a situation where Nathan could demonstrate his indispensability. He orchestrated a loan arrangement that was extraordinarily profitable for the Rothschild banking operation, while appearing to serve the government's needs perfectly. The transaction confirmed that Nathan was still the master of the financial system, that he could operate at a level of sophistication that other bankers couldn't match. But the transaction also represented something else, the peak of Nathan's power. After this operation, there would be decline, not failure, not collapse, but a beginning of diminishment. the financial innovation that had been his tool for decades, his ability to see opportunities that others missed, his ability to price risks correctly and accumulate profits from managing them, was becoming more widely understood and replicated. Other smart people were learning his techniques. The market was becoming more efficient, which meant there were fewer truly exploitable gaps between actual risk and priced risk. Nathan's response to this emerging competition was increasingly desperate. He pushed harder on his existing positions. He took bigger risks. He became more aggressive in his business dealings. He was determined to maintain his dominance, but in doing so, he was becoming less rational and more emotional. The clear-eyed calculation that had characterized his best decisions was being clouded by the emotional need to prove his superiority. There was also the matter of his personal relationships, which had become more complicated over time. Nathan had married Hannah Barrett Cohen, a member of a wealthy Sephardi Jewish family, and had produced a large family. But his wife was concerned about his health and his obsessive focus on work. His children wanted him to step back, to let them take over more of the operations. The family was becoming divided about the direction the business should take. Nathan's response to all of this pressure was characteristic. He intensified his focus on work. He spent longer hours at his office. He involved himself in more transactions. He paid attention to smaller details that he might normally have delegated. It was as if he was trying to hold back the tide of inevitable change through sheer force of will and attention. By 1835, it was clear to those around Nathan that something was seriously wrong with his health. The ailments he suffered from were becoming more serious. There were reports that he was in constant pain, that he was sometimes unable to attend to business, that his mental acuity was beginning to fade. He saw various doctors who prescribed various treatments, none of which helped, but Nathan refused to believe that he was dying, or at least refused to act as though he believed it. He continued to work. He continued to involve himself in financial operations. He continued to exercise his influence over government and markets. It was as if acknowledging that his power might be ending, that his body might be failing, that his era might be coming to a close, was simply unthinkable. There was also something almost spiritual about Nathan's addiction to power during this period. He had spent his entire adult life pursuing wealth and financial dominance. That pursuit had become almost a religion for him, the fundamental organizing principle of his existence. To step back from that pursuit, to admit that someone else might do it, to imagine a world where Nathan Rothschild wasn't the most powerful financial figure in Britain, seemed to threaten the entire meaning of his life. The cocaine winters metaphor extends in another direction as well. Just as cocaine users often experience a period where the drug no longer produces the high it once did, where they need more and more of the drug just to feel normal, Nathan was experiencing something similar with power. The operations that had once excited him, that had once felt like genuine triumphs, no longer produced the same satisfaction. He needed bigger operations, more dramatic triumphs, more complete control, just to feel like he was still winning. This psychological state made him vulnerable, in ways he had never been vulnerable before. He was taking risks that weren't carefully calculated. He was making decisions based on emotion rather than analysis. He was becoming reckless in ways that previous versions of Nathan Rothschild would never have been. In 1836, Nathan's health collapsed completely. The various ailments that had been plaguing him for years reached a critical point. He was in severe pain. He was unable to work. He was, though he probably couldn't fully acknowledge it, dying. Various doctors were brought in. Various treatments were attempted. None of it helped. On July 28, 1836, Nathan Mayer Rothschild died at his home in London. He was 58 years old. The official cause of death was listed as kidney failure. Though his health had been deteriorating from multiple sources, he had worked himself to death in a sense, the addiction to power and financial dominance pushing his body beyond what it could sustain. The cocaine winters metaphor extends to the aftermath as well. Just as a cocaine user experiences a devastating crash after the drug wears off, the financial markets experienced a kind of crash after Nathan's death. The confidence he had inspired, the sense that Nathan Rothschild was an invincible financial genius who could make everything work out, evaporated with his death. Within days, there were rumors that the Rothschild empire would collapse without Nathan at the helm. Markets became unstable. Credit began to dry up. There were questions about whether commitments that Nathan had made would be honored by his successors. The vacuum left by his death created uncertainty, and uncertainty in financial markets produces chaos. But Nathan's legacy survived. His sons, particularly his eldest son Lionel, proved capable of maintaining and even expanding the Rothschild financial empire. The structures that Nathan had built, the connections, the reputation, the systems for managing risk, proved resilient enough to survive his personal death. Within months, confidence was restored. Within years, the Rothschild empire was as powerful as it had ever been. Though it was operating under new management, what Nathan had created was bigger than any individual person, including himself. He had built a system for generating wealth from the management of financial risk that could operate independently of any single person. His innovation, the systematic analysis of risk, the creation of insurance and financial derivatives, the use of leverage and syndication to mobilize enormous amounts of capital. These were techniques that could be taught and replicated. They didn't depend on Nathan's genius. In this sense, the cocaine winters metaphor breaks down. Nathan's death didn't represent the collapse of everything he had built, the way an addict's death often represents the end of everything they achieved. Instead, his death revealed that his greatest achievement wasn't any particular financial transaction or market manipulation. His greatest achievement was the creation of a system for thinking about and managing financial risk, a system that would persist and evolve long after his death, that would shape financial markets for centuries, that would eventually spread across the entire world. The addiction that killed him, the need for power, the inability to let go, the pushing of his body beyond its limits to maintain dominance, created the conditions for his death. But the work he had done in satisfying that addiction created structures that would outlast him and would continue to shape the world long after he was gone. In the months and weeks leading up to Nathan's death, there was a sense of pilgrimage, though Nathan would never have used that term. He was not on a spiritual journey toward transcendence or redemption. Rather, he was on a journey toward the inevitable conclusion of a life spent in the relentless pursuit of power and wealth. Unlike Graham Parsons, who traveled to Joshua Tree searching for spiritual meaning, Nathan's final journey was entirely inward, a psychological and physical deterioration that he could see approaching but was powerless to stop. In early 1836, Nathan was still attempting to work despite his health problems. He would come to his office, though increasingly he would have to retire to rest after only a few hours. He would dictate letters and instructions, though the clarity that had once characterized his thinking was beginning to cloud over. He was still the head of the Rothschild empire, still the man whom the British government consulted on financial matters. But everyone around him could see that the machine was wearing down. His doctors advised him to rest, to reduce his activities, to focus on his health. But Nathan refused. He had an almost irrational need to maintain his position at the center of power, to continue to be indispensable, to demonstrate through sheer force of will that age and illness couldn't reduce his authority. This refusal was characteristic of Nathan throughout his life. He had always pushed against limits imposed by his Jewish identity, limits imposed by his foreign origins, limits imposed by his lack of inherited wealth or social position. Now he was pushing against the ultimate limit, the limits of his own body. The pilgrimage also had a social dimension. As Nathan's health deteriorated, the most powerful figures in British society made their way to visit him. Government ministers came to consult with him. Rival bankers came to assess the situation and calculate how to position themselves for after his death. Competitors came to see whether their moment of opportunity was approaching. Friends and colleagues came to maintain relationships or to observe the end of an era. These visits revealed something important about Nathan's position in British society. He was respected, feared, and relied upon. But he was not loved. There was no genuine mourning for his approaching death, only calculation about what his death would mean for various parties' interests. The power he had accumulated, the wealth he had generated, the influence he had exercised, none of it had created the kind of personal affection or loyalty that a less powerful but more beloved person might have generated. Nathan himself seemed aware of this. He was philosophical about his approaching death, in his way. He had achieved everything he wanted to achieve. He had become the most powerful financial figure in the world. He had transformed his family from provincial moneylenders in Frankfurt into a global financial dynasty. He had proven that it was possible for a foreigner, a Jew, a man without inherited wealth or social position, to exercise virtually unlimited power in British society. What more was there to accomplish? But there was also a sense of unfinished business, of projects left incomplete, of problems that wouldn't be solved before his death arrived. The financial system he had built was becoming increasingly complex and fragile. He had created structures for managing risk that worked brilliantly as long as he was directing them. But that might not survive his absence. He had accumulated enemies, powerful people, who resented his dominance and who would move to reduce Rothschild power as soon as he was no longer in a position to maintain it. Nathan's approach to these problems was to attempt to systematize his knowledge, to create structures and rules that would allow his operations to continue after his death, even without his personal direction. He worked with his sons, teaching them his methods, explaining his approach to financial analysis and market operations. He created written guidelines for how various operations should be conducted. He attempted to create redundancy in his organization, so that no single person would become too essential to the operation. This was an intellectual task that Nathan approached with the same systematic rigor he had always applied to financial problems. How do you capture intuition in written rules? How do you teach someone else to see the patterns that you have spent decades learning to perceive? How do you create an organization that will function without the founder at its center? These were the questions that occupied his mind during his final pilgrimage. There was also a spiritual dimension to Nathan's pilgrimage, though he would have expressed it in entirely secular terms. He was coming to terms with mortality, with the fact that even he was not immortal, that even the greatest power and wealth could not prevent death. He was reflecting on his life, on the meaning of what he had accomplished, on what would remain after he was gone. Some accounts suggest that in his final days, Nathan expressed some regrets. He was reported to have wished that he had spent more time with his family more time on non-financial matters, more time on enjoying the wealth that he had accumulated rather than constantly pursuing more wealth and more power. But these reports are difficult to verify, and they may simply reflect the tendency of biographers to impose a narrative of redemption and wisdom at the end of a life onto someone who may or may not have actually experienced those feelings. What's clear is that Nathan's final pilgrimage was one of accelerating deterioration, both physical and psychological. By July 1836, he was no longer able to work at all. He was confined to his home, in constant pain, receiving various medical treatments that provided no relief. He was beginning to lose consciousness, slipping in and out of lucidity, losing track of time and place. His family gathered around him. His wife, Hannah, was present. His sons were present. His daughter was present. They watched him decline day by day, hour by hour. They knew that the end was approaching. They began to make plans for what would happen after his death, how the business would be divided, who would take over various operations, how the family wealth would be managed. There's something almost absurd about the contrast between Nathan's absolute dominance in the financial world just months earlier and his complete helplessness in his final days. The man who had exercised power over governments and markets, who had moved millions of pounds with a word, who had altered the course of national economic policy through the sheer force of his will, was now unable to move, unable to speak coherently, unable to do anything except lie in bed and wait for death. On July 28, 1836, that death came. Nathan Mayer Rothschild died in his home in London, surrounded by his family. The official announcement was that he had succumbed to his ailments. The financial markets, when they learned the news the next day, experienced a moment of shock. But the shock was followed quickly by calculations about what the death would mean for various business interests. Within days, newspapers carried obituaries that attempted to assess Nathan's life and legacy. He was called a financier of genius. He was called a man who had accumulated unprecedented wealth. He was called a figure who had shaped British financial history. Some critics suggested that he had exercised too much power, that his influence over government policy had not been entirely beneficial. Others celebrated him as a great figure of the age. What's notable is that almost none of the obituaries focused on Nathan as a person, on his personality, his character, his human qualities. Instead, they focused on his accomplishments, his wealth, his power. This reflected something true about Nathan's life. He had made himself into an instrument of financial power rather than remaining a full human person. He had sacrificed personality, relationships, and enjoyment for the accumulation of wealth and power. In this sense, his final pilgrimage was fundamentally different from Graham Parsons' pilgrimage to Joshua Tree. Parsons was searching for something spiritual, something transcendent, something beyond the material world. Nathan had rejected that kind of searching entirely. His entire life had been devoted to purely material accumulation. And in the end, when he lay dying, all of that material accumulation couldn't purchase him another day of life, couldn't reduce his pain, couldn't prevent the arrival of death. But Nathan didn't experience his death as a failure or a cause for regret, in the way that Parsons' death might be seen as a tragic waste of potential. Nathan had accomplished what he set out to accomplish. He had become the most powerful financial figure in the world. He had built structures that would persist after his death. He had proven that it was possible to exercise virtually unlimited power through the manipulation of financial instruments and through an intimate understanding of risk, Whether that accomplishment was ultimately beneficial to the world is a question that remains contested. Nathan's life and work shaped the financial system that would dominate the 19th, 20th, and 21st centuries. That financial system has generated extraordinary wealth and prosperity for some people. It has also generated enormous suffering for others. The question of whether Nathan should be celebrated as a financial genius or criticized as a figure who created systems of exploitation and inequality depends largely on one's political and moral perspective. What's clear is that Nathan's pilgrimage toward death was a pilgrimage toward the inevitable conclusion of a life lived for a single purpose: the accumulation of power through the management of financial risk. Unlike Parsons, who was searching for transcendence and found only destruction, Nathan found exactly what he was searching for. His destruction, when it came, was not the result of his search failing, but of his body finally giving out after decades of stress and overwork. It was not tragic in the way that Parsons' death was tragic. It was the end of a long, disciplined pursuit of a singular goal. It was, in Nathan's terms, success even unto death. The death of Nathan Mayer Rothschild in July 1836 sent shockwaves through the financial world that echoed for months and years. Like Graham Parsons' bizarre death and cremation in the desert, Nathan's death became a kind of mythological event, an ending that seemed to encapsulate everything about his life and work. But where Parsons' death became legendary through the circumstances surrounding it, the body theft, the desert cremation, Nathan's death became legendary through what it revealed about the systems he had created. The immediate aftermath of Nathan's death was a period of acute anxiety in financial markets. There were genuine questions about whether the Rothschild Bank would survive without Nathan's direction. There were rumors that major commitments Nathan had made would not be honored. There were suggestions that competitors might move to dismantle the Rothschild empire, now that its founder was gone. For several weeks, the financial world held its breath, waiting to see whether the system Nathan had built was robust enough to survive his absence. But within days of Nathan's death, his sons, particularly his eldest son Lionel, moved to demonstrate that the empire would continue. Lionel and his brothers made clear that all of Nathan's commitments would be honored, that the Rothschild Bank would continue to operate at full capacity, that there would be no disruption to the services the bank provided to its clients. By their decisive action, they provided the reassurance that the market needed to avoid panic. This proved to be extraordinarily important. The confidence that Lionel and his brothers inspired prevented what could have been a major financial crisis. If the market had lost confidence in the Rothschild Bank, if it had believed that the death of Nathan meant the end of the institution, there could have been a run on the bank, a seizure of credit, a systemic crisis that would have damaged the entire British financial system. What Lionel and his brothers had demonstrated was something crucial about Nathan's legacy. The system he had created was bigger than any individual person, including Nathan himself. The procedures he had established, the relationships he had built, the reputation he had cultivated, these were not dependent on his personal participation. They could be maintained by competent successors. In this sense, Nathan's death was quite different from Graham Parsons' death. Parsons' death represented a genuine ending. The music that he might have created would never be created. The influence he might have exercised would never be exercised. The artistic potential that had animated his life was extinguished forever. Nathan's death, by contrast, represented a transition. The work would continue. The empire would persist. The systems he had created would operate indefinitely. But there's another dimension to Nathan's legacy that might be expressed through the burning ghost metaphor, the way that his influence continued to haunt financial markets and financial policy even after his death. The principles he had established, the approaches he had pioneered, the way of thinking about financial risk and financial opportunity that he had embodied, all of these continued to shape how finance operated for decades and centuries after his death. Other financial institutions adopted the techniques Nathan had pioneered. The insurance market evolved along the lines that Nathan had established. The approach to assessing and pricing risk that he had developed became standard practice throughout the financial industry. In this sense, Nathan's ghost burned on, continuing to shape the behavior of financial actors who had never met him and were operating in very different times and circumstances. The metaphor also captures something about the dark side of Nathan's legacy, the financial system that he had helped create, a system based on the calculation and management of risk, divorced from ethical or moral considerations, operating according to pure profit maximization logic. This system continued to generate both extraordinary wealth and extraordinary suffering. The burning ghost of Nathan Rothschild haunted financial markets, shaping them in directions that benefited some people immensely while harming others. The question of who specifically is harmed by a purely profit-maximizing financial system is complex and contested. In some senses, almost everyone benefits from an efficiently functioning financial system that allocates capital to productive uses. But in other senses, a financial system that is purely driven by profit maximization creates incentives to finance projects that are destructive: colonial extraction, labor exploitation, environmental degradation. If they are profitable, Nathan himself had pioneered the financing of such projects, had proven that it was possible to profit enormously from ventures that involved the suffering and exploitation of others. In the months after Nathan's death, various people attempted to assess his legacy and what his life meant. The financial press celebrated him as a genius, as the founder of the modern banking system, as a figure of extraordinary achievement. The radical press attacked him as the symbol of capitalist exploitation, as the evidence that under capitalism, a single individual could accumulate nearly unlimited power through the manipulation of financial systems. What's notable is that both perspectives contain truth. Nathan was, by any objective measure, a financial genius. He had innovated in ways that few others could have innovated. He had built systems that continue to shape how finance operates even today. But he was also a figure who had helped create and refine systems that facilitate exploitation and suffering. He had pioneered the idea that profit-seeking divorced from ethical consideration was not just acceptable, but necessary and natural. Nathan's ghost in the financial system became increasingly visible as the 19th century progressed. The crash of 1847, the financial crises of the 1860s, the booms and busts of the 1870s and 1880s, all of these reflected the operation of the financial system that Nathan had helped create. The ability of financial systems to generate wealth and devastate lives simultaneously. The ability of financial manipulation to create crises that harmed millions of people. The disconnect between financial success and actual human welfare. All of these characteristic problems of financial capitalism were evident in the decades after Nathan's death. In some ways, Nathan's burning ghost became even more powerful and influential after his death than it had been during his lifetime. While he was alive, he was simply one financial player among others, albeit the most powerful one. After his death, he became a symbol, an idea, a representation of financial power and the financial system itself. Everything, about how capitalism worked financially came to be understood through the lens of what Nathan had created and represented. The Rothschild Bank itself continued to prosper after Nathan's death. His sons and grandsons built on the foundation he had created, expanding the bank's operations, maintaining its dominance in British finance, extending its reach into new areas and new countries. The Rothschild dynasty that Nathan had founded became one of the most powerful financial forces in the world, continuing to exercise enormous influence well into the 20th century. But the burning ghost metaphor also suggests something else. The way that Nathan's death, like Parsons' death, became caught up in mythology and legend. Stories about Nathan became more elaborate and dramatic over time. His financial coups became legendary. His influence over government policy became mythologized. The truth about what he had actually done became mixed with speculation, anti-Semitic conspiracy theories, and various versions of his life story tailored to serve particular political or ideological purposes. Just as Graham Parsons' death in the desert and his body's subsequent cremation became the organizing narrative of his life, Nathan's death became the moment around which his entire legacy was organized. The date of his death, the circumstances surrounding it, the immediate aftermath when his sons took over. All of these became touchstones in the narrative of his life. The burning ghost also refers to the way that certain ideas don't die, but continue to burn, continue to provide light and heat, even after their originator is gone. Nathan's fundamental insight, that the ability to calculate and manage financial risk is more important than almost anything else, that profit divorced from ethical consideration is natural and necessary, that financial engineering can be applied to any sphere of human activity. These ideas continue to burn in financial markets to this day. The question that Nathan's burning ghost raises is whether this is a positive or negative development. Did Nathan create something beneficial? A sophisticated system for allocating capital, managing risk, and financing productive ventures? Or did he pioneer a form of capitalism that, while spectacularly profitable for some, has created enormous suffering, environmental destruction, and inequality? The answer, of course, is that Nathan did both. His financial innovations have been genuinely useful for managing risks, for financing productive ventures, for allowing capital to flow to where it can be used most productively. But those same innovations have also been used to extract value from productive activity, to shift risk from the wealthy to the poor, to facilitate exploitation and environmental destruction, to create financial crises that devastate lives. Nathan's burning ghost continues to haunt financial markets today. Every time a financial engineer creates a new derivative or financial instrument, they are following a path that Nathan pioneered. Every time a bank or financial institution evaluates a potential investment based purely on whether it will be profitable, they are embodying the approach that Nathan developed. Every time a financial crisis devastates the lives of ordinary people while enriching financial speculators, the ghost of Nathan's approach to finance is visible. In this sense, Nathan's legacy is not the past but the present, the financial system that he helped create, that operates according to the principles he established, that embodies the approach to risk and profit that he pioneered, is not a historical artifact, but a living, breathing system that continues to shape the lives of billions of people. His death in 1836 ended his personal involvement in finance, but his burning ghost continues to shape the financial world. In the nearly 2 centuries since Nathan Mayer Rothschild's death, his legacy has been subject to continuous reinterpretation, mythologization, and contested understanding. Unlike Graham Parsons, who has been increasingly recognized as a genius by musicians and critics, or Nathan's own reputation in financial circles, which has remained consistently celebrated. The broader public understanding of Nathan has become increasingly complicated, conflicted, and, in many cases, distorted by anti-Semitic conspiracy theories and alternative historical narratives. The immediate post-Nathan era, the decades following 1836, saw the full institutionalization of the Rothschild empire under his son's direction. Lionel Rothschild became the most prominent member of the family, eventually becoming a member of parliament and becoming the first Jewish MP to take his seat in the House of Commons. His career represented a continuation and expansion of Nathan's work, maintaining Rothschild dominance in finance, exercising influence over government policy, and continuing to expand the family's business operations. But something also shifted after Nathan's death. The Rothschild Bank became more formal, more corporate, less dependent on individual genius, and more dependent on institutional procedures and inherited capital. In some ways, this was a sign of success. Nathan's creation was robust enough to survive and thrive without his personal direction. In other ways, it represented a loss of the innovative edge that Nathan had brought to finance. Later, Rothschilds would be successful and powerful, but they would not innovate in the way that Nathan had innovated. The financial system itself evolved in ways that would have both pleased and concerned Nathan. The principles that he had pioneered, the systematic analysis of risk, the use of financial instruments to manage risk, the application of mathematical analysis to financial decision-making, these became increasingly central to how finance operated. Insurance developed along the lines that Nathan had established. Banking evolved in directions that Nathan's innovations had pioneered, but the financial system also became more complex and less transparent. The financial innovations that Nathan had pioneered were designed to be understood by a relatively small number of highly trained financial specialists. By the late 19th and 20th centuries, financial innovations had become so complex that even sophisticated investors couldn't fully understand them. This complexity created both opportunities for financial engineers to extract value and vulnerabilities that could explode into crises when things went wrong. Nathan's legacy in Lloyd's specifically is complex and contested. While Nathan was not the founder of Lloyd's, that distinction belonged to Edward Lloyd, whose coffee house had become the centre of London's maritime insurance market. Nathan was instrumental in transforming Lloyd's from a loose collection of individual underwriters into a more organised market. The procedures, the regulatory frameworks, and the approach to risk assessment that Nathan pioneered shaped how Lloyd's operated for centuries after his death. By the early 20th century, Lloyd's had become one of the world's most important insurance markets. It had evolved into a sophisticated institution with complex procedures for underwriting, managing risk, and paying claims. The basic principle that Nathan had helped establish, that risk could be understood mathematically, that appropriate prices for insurance could be calculated based on historical data and probability analysis, had become foundational to how Lloyd's operated. But Lloyd's also became a symbol of the problems that can emerge from a purely profit-driven approach to insurance. In the late 20th century, Lloyd's faced a series of catastrophic losses from catastrophic events, natural disasters, industrial accidents, environmental liabilities. These losses revealed that the models for calculating risk that Nathan had pioneered, while effective in many situations, could be catastrophically wrong when faced with truly unprecedented risks. the question of what constitutes proper risk assessment and appropriate insurance pricing remains contested to this day. Nathan believed that historical data and mathematical analysis could provide reliable guides to future risk. But history shows repeatedly that the risks that matter most, the risks that cause the biggest losses and create the biggest problems, are often the risks that don't appear in historical data, that haven't happened before, that are, by definition, not well understood. Nathan's broader legacy in finance and risk management is similarly complex. On one hand, he pioneered an approach to financial analysis that has been enormously productive, that has allowed better allocation of capital, that has facilitated economic development. The techniques of actuarial analysis, of systematic risk assessment, of financial engineering that Nathan pioneered are genuinely valuable tools for managing uncertainty in complex economies. On the other hand, Nathan pioneered an approach to finance that is fundamentally immoral, that treats the question of profit-seeking as entirely separate from questions of ethics or social consequences. This approach has facilitated not just productive finance, but also exploitative finance, finance designed to extract value from vulnerable populations, to shift risk from the wealthy to the poor, to fund ventures that are profitable but destructive. Nathan's legacy is also caught up in anti-Semitic conspiracy theories. The fact that Nathan was Jewish, that he became enormously wealthy, that he exercised tremendous influence over government policy. All of these have been used as fuel for anti-Semitic narratives about Jewish bankers controlling the world, about hidden conspiracies of Jewish financial figures manipulating governments and markets for their own benefit. These conspiracy theories are grotesquely anti-Semitic and factually false, but they have become so widespread that they obscure the actual history of Nathan's life and work. The truth about Nathan is that he was a brilliant financial innovator who happened to be Jewish, not that he was part of some vast Jewish conspiracy to control the world. He was an individual who, through superior analytical ability and ruthless focus on profit maximization, achieved an extraordinary degree of financial power. His being Jewish was part of his identity, and anti-Semitic restrictions on his social mobility may have in some ways driven him to focus more intensely on financial success. But his achievements were his own, not the product of some collective Jewish effort to control finance. In popular culture and in broader public discourse, Nathan's legacy has become increasingly unclear. Many people have heard vaguely that the Rothschilds are some kind of powerful banking family, but few understand the actual history of how that power was built. Conspiracy theories, historical fiction, and popular entertainment have created a distorted image of Nathan and the Rothschild family that bears little resemblance to historical reality. What's interesting to consider is how Nathan's legacy compares to other great figures of his era, other financiers, entrepreneurs, politicians, military leaders. Nathan accomplished far more in terms of actual financial power and influence than most of his contemporaries. Yet he is far less well known and far more subject to distorted interpretation. This may reflect the fact that finance is less interesting to most people than military conquest, political drama, or artistic creation. Or it may reflect the anti-Semitic conspiracy theories that have clouded the public understanding of Nathan's life and work. The question of whether Nathan's legacy is ultimately positive or negative has no simple answer. His innovations in finance, insurance, and risk assessment have been genuinely useful. They have facilitated economic development, allowed better allocation of capital, and provided tools for managing uncertainty. But those same innovations have also been used to exploit vulnerable populations, to shift risk from those who can bear it to those who cannot, to create financial crises that devastate lives while enriching financial speculators. Nathan himself was not conflicted about the moral and ethical dimensions of his work. He believed that seeking profit was natural and appropriate, that the moral quality of what one financed was not the financier's concern, that the role of finance was to allocate capital efficiently, not to make ethical judgments about how that capital was used. By the standards of his time, this was not an unusual position for a banker or financier to hold. But it was a choice nonetheless, and it had consequences. The legacy that Nathan left is essentially a set of tools and techniques for analyzing risk and generating profit from uncertainty. Those tools can be used for beneficial purposes or for harmful ones. They can facilitate productive economic activity or exploitative extraction. The question of how those tools should be used is not a question that Nathan attempted to answer. He left that to others. In the 19th and 20th centuries, financiers following in Nathan's footsteps used those tools to build an increasingly complex and powerful financial system. That system has been extraordinarily productive in many ways, generating wealth and facilitating economic development. It has also created enormous suffering through financial crises, through the financing of destructive ventures, through the extraction of wealth from vulnerable populations. Today, nearly 2 centuries after Nathan's death, his ghost continues to haunt finance. The principles he established continue to guide how risk is assessed and how insurance is priced. The approach he pioneered, seeking profit divorced from ethical considerations, viewing finance as a purely technical exercise in risk calculation, continues to characterize how many financial institutions operate. The question that Nathan's legacy raises is whether this is the appropriate way for financial systems to operate, or whether there are other possible approaches. Should finance be purely a technical exercise in risk management, or should it incorporate ethical and social considerations? Should financial institutions pursue profit above all else, or should they balance profit-seeking with concerns about social consequences? These are not questions that Nathan would have asked. He was a creature of his time, operating according to the assumptions and values of early 19th century capitalism. But they are questions that we must ask in the 21st century as we confront the consequences of 2 centuries of financial development, following the principles that Nathan pioneered. Nathan Mayer Rothschild's legacy is neither wholly positive nor wholly negative. It is a complex, contested, and still unfolding legacy. His innovations have been genuinely important for the development of modern finance. His ruthless focus on profit and his indifference to social consequences established a model of financial practice that has been enormously influential. Whether that influence has been ultimately beneficial or harmful remains a question that each individual must answer, based on their own values and their own assessment of the evidence. What's certain is that Nathan changed the world. He showed that an individual without inherited wealth or social position could, through superior understanding of finance and ruthless focus on profit, achieve extraordinary power. He pioneered techniques of financial analysis and risk management that continue to be used today. He built institutions that continue to exercise influence, and he established a model of finance that, for better and worse, continues to shape the world more than 185 years after his death.